Assalamu alaikum friends, welcome to SPR revision series for September 2021, and today we are going to cover one of the most challenging standards in your SPR, IFRS 9, financial instruments. Two more standards are relevant for this. One is IS 32, which is the presentation of financial instruments, and the other one is IFRS 7, disclosure of financial instruments, and both of this I have covered. So this one will be the main financial instruments, and here we are going to go through the recognition, initial recognition and subsequent treatment of both financial asset and financial liability. What is financial liability? What is financial asset has been explained in IS 32, and financial asset impairment, derecognition of financial instruments, derivatives, and hedge accounting. So whenever you're studying this standard, this particular standard, because there are so many areas to this standard, okay, break down the standard into small pieces and then study rather than studying everything together, because then it becomes very confusing. For example, you have decided that today I'm going to study financial asset. Just study financial asset until you don't become expert in that. Then you go to financial liability, then you go to equity instrument, then you go to debt instrument, then you go to hedge accounting, then you go to derivatives. Slowly by slowly you will be building up on each, and then finally you will be attempting a question which includes all of this. Okay, so starting with financial liabilities. Okay, in my earlier video under IS 32, financial liability is when you have an obligation to pay financial asset, cash. Okay, here we are talking about the initial recognition. Okay, so initially you recognize it at fair value, financial liabilities. Okay, and if the financial liability will be held at fair value through profit and loss, then any transaction cost will be expensed in the profit and loss account. If not, that means if you are not holding it through fair value, then transaction cost should be deducted from its carrying amount. Okay, so these two differences you should know. If the financial liability is held at fair value through profit and loss, then transaction cost is expense. If not held through profit and loss, then transaction cost is deducted from the carrying amount of the financial liability. But initial recognition is fair value only. Next, we are going to the subsequent treatment of financial liabilities. So the subsequent treatment, there's a choice. It can either be measured at amortized cost or fair value through profit or loss. Initial, it is fair value, but subsequent measurement, amortized cost or fair value through profit and loss. For financial liability we are talking about. Okay, and how to do this, it's given, especially the amortized cost part. When I explained IFRS 9 and I did questions also, it's there in my SBL lecture. You will find it out. Okay, I think there were 10 parts to IFRS 9, so out of one of it where financial liability is discussed, there I've explained with numbers and all. So I'm not going to do it here. Okay, this is just a quick revision. So amortized cost, let us go in depth to amortized cost. So amortized cost, this category is used for most of the financial liabilities, okay, for the treatment. And interest income, when you're calculating, remember financial liability, so interest comes. Okay, so interest income is calculated using the effective rate. Effective rate will be given. This will be charged to profit and loss because it's an interest income. It will go to profit and loss, and it increases the carrying amount of the financial liability. Remember, interest you have to pay on a liability. Normally, when you take a loan from a bank, it's a liability. You pay an interest, so that interest is added to the amount of the principal. Same way here, it will be added to the financial liability, the carrying amount of financial liability. If you are making any cash payment, it will reduce the liabilities carrying amount because you are paying in cash. So your liability will go down. Okay, under amortized cost. Now we are going through fair value through profit and loss. So when you're going through fair value through profit and loss, this category is used for derivatives or liabilities that are held for trading. It could be for derivatives also, remember, because fair value derivatives we measure through fair value through profit and loss. Okay, so it could be for derivatives, it could be for liabilities, but which is held for trading, because mostly trading items only go through profit and loss. If you are not trading something, it does not go in profit and loss account. Okay, so it's easy to remember it in that way. Financial liability is revalued to fair value at the reporting date. Every year, every reporting date, financial liabilities are revalued to fair value with a gain or loss in the profit and loss. That's the reason the meaning is fair value through profit and loss. So if any gain or loss comes because of the revaluation to fair value, will go through profit and loss. But you can make a designation where you can say that you want it to go through other comprehensive income. That is also acceptable. But if you make that designation, okay, mostly this designation is made so that an accounting mismatch is reduced. If you are making this designation, then you have to record it in two places. Okay, number one, the change due to the own credit risk is reported in OCI. See, the fair value can change because of the changes is own credit risk. You're defaulting on payment, you're not able to pay. So it's known as your own credit risk, your own worthiness is going down. Because of that, if fair value changes, that will be recorded in OCI. Okay, but the remaining change, other than that, if there is any change, other than that own credit risk, if the fair value changes, that extra change will go in profit and loss account. Understanding, because that for credit risk, whatever change is happening, it is not happening from the normal activities, normal trading activity. That's why it's reported in OCI. Other than that, change is reported in profit and loss account. If you make this designation that it should be through OCI, fair value through OCI. Now we are moving towards financial asset. That's it for financial liability. We have discussed both fair value through profit and loss and amortized costs, and the designation also that you can make. Coming to the financial asset, this is a very big topic, financial asset in itself, because most of the things here onwards what we are going to cover will be on financial asset. Even financial asset impairment is also there later on. So financial asset, as we have discussed previously, financial asset is a right to receive cash or financial or equity instruments, right? So here also you have to know the initial recognition and subsequent measurement, like how we went through financial liability. So financial asset, you initially recognize it at fair value, same like your financial liability. And this one also, if it is held at fair value through profit and loss, then transaction cost expense to profit and loss. This is similar to financial liability, but the difference is here in the next one. If it is not held at fair value through profit and loss, then transaction cost is added to the carrying amount. In the financial liability, it was deducted. Here it is added to the carrying amount. So this is the difference. The rest other 2 points are same for financial liability also. Now we are moving to the subsequent remeasurement. But before that, we have to know that financial asset could be of two types. Investments could be of two types under financial asset. One is known as investment in equity, the other one is investment in debt. Okay, both are financial assets only. So investments in equity, that means if you're having an investment in ordinary shares of a company, that is known as investment in equity. So how do you treat with that? You can say investment in equity instruments, such as investment in ordinary shares of another entity. Normally, for business combination and all, when you have bought a subsidiary or associate, so this is one such example where you are investing in ordinary share. That means you are having less than 20%, which is dealt under Ifrs 9. That is financial asset only, that investment in equity instruments. Okay, so that is normally measured at fair value through profit and loss. Next, but it is possible that you can measure an equity instrument at fair value through other comprehensive income also, provided that equity instruments are not held for trading. Remember, if anything is held for trading, profit and loss account. If not, then you can tell that okay, OCI. So if equity instrument is not held for trading, number one, and number two, you have made an election, an irrevocable choice. Okay, and when did you make this choice? In the initial recognition of the asset, that you are going to designate this as fair value through other comprehensive income. This is for investment in equity we are talking about. Once you make that election, you cannot change it. It's irrevocable. And also it is not held for trading. In these two conditions, you can held the equity instrument at fair value through other comprehensive income. Otherwise, it is fair value through profit and loss. Okay, if you're forgetting these points, I would recommend you to write down this point that I'm talking. Okay, because everything cannot be understood from reading notes. Sometimes you need to write the words that I'm saying. So make sure that you pause the video and write down the important points, because this topic is very important and is very confusing also. It's easy when you're studying part by part like this, but when it comes in a question, together everything you have to remember. Whether it is investment in equity or debt, if it's equity, what is initial recognition, what is subsequent measurement, all those things becomes very tricky that time. That's why I'm telling you. Okay, and multiple attempts, multiple times you have to do these questions on this area. It needs to be done to understand this topic very well. So investments in equity can be two types: fair value through profit and loss, fair value through other comprehensive income. Fair value through profit and loss normally, but fair value through other comprehensive income, two condition has to be there: not held for trade and irrevocably you have designated it. Now we are moving to investment in debt. Okay, the second type. Remember, don't get confused with this with financial liability. This and financial liabilities are not same. Okay, investment in debt means investment in bonds or loans. So this is your financial asset. Why? Because you are going to receive. You are not taking a loan. You are giving a loan to someone else. You are having receiving the cash by investing in that bond or that loan. That's why it's a financial asset for you. Same for equity instruments. You are having equity shares, ordinary shares in other company. You are going to get any benefit out of it. You have the right to receive the cash. That's the reason it's a financial asset. Okay. Now, so investment in debt can be measured in one of the three ways. Okay, one is amortized cost. Okay, if the business model is that the business model is to collect the contractual cash flow. What is contractual cash flow? Only interest and the principal amount. Okay, and you are holding that debt until the maturity date. You are not selling it, you're holding it. Then amortized cost. Then, so this contractual cash flow means only the payment of principal and interest, because it's a debt, so in principal and interest. Then the second way is fair value through other comprehensive income. If your business model is to hold it until maturity and then sell this debt, this investment in debt, that means you're selling of the bond, then you're using fair value through other comprehensive income. Okay, you're selling that financial asset off. You're holding it and selling the financial asset. That investment in debt is a financial asset. You are selling it. Okay, so same, the contractual term means the cash flow that you're receiving has to be payment of interest and principal solely. Coming to the profit and loss account, whatever is not measured at amortized cost of fair value through OCI is measured through fair value through profit and loss. For debt instrument, there is no such thing, no condition attached. Okay, now we are coming to, so this is the summary of whatever I've explained. Three methods you can measure investment in debt: amortized cost, OCI, profit and loss. Amortized cost, remember, you have to pass through a test. It is known as contractual cash flow characteristics test. That means what type of cash flow your company is having. It should have interest and principal amount that you have a right to receive. Same for other comprehensive income also. But only the business model is different under amortized cost and OCI. Amortized cost, you are holding the maturity until yes, you are holding the debt, that financial asset until maturity. That means you are not selling it. Other comprehensive income, you are holding it and then selling it at the year end. Profit and loss account, if it's neither amortized nor OCI, then fair value through profit and loss. In your exam, if that, how will you know if it's fair value through profit and loss? They will clearly tell you it's not amortized cost, it's not OCI, then fair value through profit and loss. Now we are coming to financial asset impairment, like how any asset are impaired, how your assets under IS 16 or intangible assets are getting impaired. Same way financial assets also are charged to impairment. Okay, so how do you calculate this impairment? So this impairment rule applies in IFRS 19 only to debt instruments, remember. Okay, measured at amortized cost or fair value through OCI, remember the first two methods for debt instruments. Either it has to be measured at amortized cost, either it should be measured through OCI. If it is measured fair value through profit and loss, we are not using the impairment rule. Okay, only for the first two methods, then impairment rule applies for it. IFRS 9 impairment rule we are talking about, because impairment, most of the students might get confused with IAS 36. There also it's an impairment, but that impairment and this IFRS 9 impairment are two different things. Okay. For financial asset within the scope of impairment rules, entities must calculate a loss allowance. Okay. If financial asset has the scope of having this impairment, then loss allowance has to be calculated. So any increase or decrease in this loss allowance are charged to profit and loss account because it's an expense. And this loss allowance must be equal to what? 12-month expected credit loss. Okay. What is this 12-month expected credit loss? We are going to go through the definitions in the next slide. If credit risk has not increased significantly, if credit risk increased significantly, then it's a lifetime expected credit loss. Okay. So here are the definitions, some very important definitions, the four important definitions. Credit loss. What is credit loss? Remember, this is a debt instrument. So debt instrument has credit also, credit loss, credit risk attached to it. Okay, credit loss. That's the reason we are talking about financial asset impairment, because if there's a credit loss, asset will be impaired. So credit loss means the difference between the contractual cash flow that is due to the entity and what you expect to receive. It's not the same. Okay, that's why there's a credit loss. It's known as credit loss. Second, expected credit loss is the weighted average credit losses. Definitely, you don't have to know these definitions and all by heart and all. It's not needed. You just have to this is for your understanding purpose. I've included this slide here, the definitions. Lifetime expected credit losses means from all the possible event, you have concluded that there will be a losses only. Okay, and you will not recover from this loss lifetime. And 12-month expected credit losses means only the proportion of that lifetime expected credit losses you are taking. Okay, that arise from default events within the 12 months of the reporting date. This will change. Okay, that means credit risk did not increase very significantly. That's why it's only 12-month expected credit loss. That means next year it might change, it might reverse. But lifetime expected credit losses means credit risk has increased very significantly, that there is no chance that the condition is going to improve. That's why we are calculating a lifetime expected credit losses forever. Okay. Now we are moving towards derecognition of financial instrument. When do you derecognize? How do you account for that derecognition and all? Okay. So we derecognize financial instrument if one of this following has occurred. This is about financial asset. Number one, you have lost that right, the contractual right to receive the cash flow. It is expired. Okay. Number two, you have sold off the asset. The financial asset has been sold off. So once you sold off, any risk and reward of that ownership has been transferred to the seller, buyer. In that case also you derecognize financial asset. Financial liabilities derecognize if the obligation is cancelled, expired, or is discharged. Okay. Now how do you account for this derecognition? So the accounting treatment of derecognitions are as follows. Number one, you first need to find the difference between the carrying amount of an asset or a liability and the amount received or paid. Okay, should be recognized in profit and loss for that period. That means you have to find a profit and loss because you're selling off. When you're selling, profit and loss, you will have to recognize it. Okay. Second, investment in equity instruments at fair value through other comprehensive income. Okay, so any cumulative gain or losses that are recognized in that OCI will not be reclassified to profit and loss when you dispose of that equity instruments. Remember, it is not reclassified. This is only for equity instruments at OCI, which is not reclassified to profit and loss on disposal. Okay. But for investments in debt instruments, okay, it will be reclassified. If you are selling off that debt instruments, any gain or losses on other comprehensive income will be recognized, reclassified to profit and loss. Okay. So remember this difference between equity instruments and debt instruments. Equity instruments not reclassified. Debt instruments are reclassified. It's in bold. Now let us move on to the derivatives after derecognition. So derivatives are financial instrument that has the following characteristics. It is an example of financial instrument only. Number one, its value changes in response to an underlying variable. That means value of a derivative is dependent on another variable. That if that variable changes, value of derivative also will change. Second, it does not require so much of investment. And third, it always will settle at some future date. So these are some characteristics of a derivative. For example, options, future, forward, money market, these are examples of derivatives that you use to hedge. You will be settling it at the future date. No initial investments are required, and value of it also changes based on the variables. Now, derivatives are always measured at fair value through profit and loss. Nothing to do with amortized cost, nothing to do with fair value through OCI. Always at fair value through profit and loss. Now, hedge accounting. We need to know hedge accounting. There are two types of hedge. One is fair value hedge, the other one is cash flow hedge. First, let us go through fair value hedge. What is fair value hedge? Fair value hedge means when there is a change in the fair value and you are exposed to a risk, especially if the fair value goes down of an asset. It's a risk. So you have to hedge that risk. Remember the purpose of hedging? To manage risk, right? Under risk management, we hedge risk. We take derivatives and all to hedge our risk, foreign exchange risk. In our advanced financial management, we went through that. But here, we are hedging fair value. Okay? And mostly fair value hedges for those items that can affect profit and loss. Okay? But it can also affect other comprehensive income only for equity investments that are measured at OCI. Because fair value recognized at OCI for equity instruments will never be reclassified to profit and loss. That's why they told it will be affecting other comprehensive income. And the second one is known as cash flow hedge. Cash flow hedge means there are changes in the cash flow, variability in the cash flow. You need to hedge that. Okay. So, or they are highly probable forecast transactions that could affect profit or loss. So cash flow hedge is mostly risk in the cash flow. Cash flow will change, and fair value is about anything that affects your profit and loss account. Okay. So hedge accounting says that derivatives introduce volatility into profit and loss. Because derivatives are there, your profit and loss are very volatile. So hedge accounting helps to reduce that volatility and make it more stable. That means you are managing it. Okay. You are designating one or more hedging instruments so that their change in fair value is offset. Understanding? If anything changes in the fair value of the hedging instrument, it will be offset by the change in the fair value or cash flow of a hedged item, the item that you are hedging. So it will be offset. That's the reason you are taking hedge accounting. If you are not taking it, then the changes in the fair value will be very volatile and it will affect your profit and loss. That's the reason we are using hedge accounting. But there are some conditions that needs to be there to apply this hedge accounting. Okay? You just cannot pick up and use hedge accounting according to your wish. No. There are some criteria that you need to meet. So this hedge accounting can only be applied if hedging relationship meets the following. Number one, both hedging instrument, derivatives that you are taking, and the hedged item, the amount that you want to hedge, they both should be eligible. Okay. Number two, the hedge formal documentation should identify the hedged item and the hedging instrument. You should identify it separately that this is the hedged item that you want to hedge. Okay, let's say the inventory, fair value of the inventory you want to hedge, and this is the hedging instrument, the contract, the derivative that you have taken. Third, hedging relationship is effective. Their relationship between the hedged item and the hedging instrument has to be effective. Okay, and if a hedged item is a forecast transaction, remember you are sometimes hedging based on a forecast. So if you think that this forecast is likely to happen, it's very highly probable, this transaction, then you can use hedge accounting. Now, a hedging relationship, how do you know whether hedging relationship is effective or not? If it meets the following three criteria. Okay, number one, the relationship between hedged item and the hedging instrument has to be economic. Number two, the effect of the credit risk does not dominate the value of changes that result from the economic relation. What does it mean? See, if the credit worthiness of a counterparty to a derivative, let's say, reduces, what happens? The value of the fair value of the hedging instrument goes down. Okay, but that uh, fair value which went down of the hedging instrument is not equal. It has nothing to do with the changes in the fair value of the hedged item. You're saying it's unrelated. They are not related. That change in the fair value of the hedging instrument happened because of the credit risk, but it was not because of the hedged item. The changes in the fair value of the hedged item, they are not. It's not related. So the effect of the credit risk does not dominate the value changes. It should not affect. If it does not affect, yes, then hedging in a relationship is effective. Otherwise, no. Third, the ratio. The hedge ratio of the hedging relationship is the same as that resulting from the quantity of hedged item and the entity actually hedges, and the quantity of the hedging instrument that the entity actually uses to hedge that quantity of hedged item. Okay, so the quantity of hedged item that they actually hedge versus that they want to hedge, it's same. The hedge ratio, that is known as hedge ratio of the hedging relationship. Okay, hedging instrument and hedged item will be similar, so the ratio will be almost similar. So in this case, it is known as hedging relationship is effective. That means it's a good relationship will work. Now, how do you account for fair value hedge and how do you account for cash flow hedge? Very important is this. I have done a question on this, so make sure that you do questions on this too. So let us first go through fair value hedge. At the reporting date, you remeasure it to the fair value, the hedging instrument. That means the derivative, for example, let's say future or options that you are using as a derivative, that you have to measure at fair value. Second, carrying value of the hedged item also will be adjusted to the fair value because this is a fair value hedge. That means fair value has changed. So that changed item you have to show in the hedged item also. Carrying by increasing the carrying amount, by changing the carrying amount to the fair value when you went for that hedge. Now we are talking about the gain or losses. How the gain or loss will be affected. Mostly this is the important part. That's why we went to the hedging. Okay, fair value hedge. So the gain or loss on the hedging instrument and the loss or gain. Did you see the difference? If there's a gain on the hedging instrument, there'll be a loss in the hedged item. If there's a loss in the hedging instrument, there'll be a gain in the hedged item. It's an inverse relationship. That's why it's offset, no? So this will be recorded like this. Most of the time, it will be in the profit and loss only. Okay, we are talking about fair value hedge. But it can be recorded in OCI also. When? If the hedged item is an investment in equity. Remember, investment in equity can never be reclassified to profit and loss. It will always be in OCI. That's why. For investment in equity, it will affect OCI. For hedged item, that is measured at fair value through OCI. Now we are moving towards cash flow hedge. This also will be remeasured to fair value at the reporting date. And what about the gain or loss? Gain or loss will go to OCI. Unlike fair value. Fair value it goes to profit and loss, but this will go to other comprehensive income. But for gain or loss on the hedging instrument, remember, if whether it's a gain or whether it's a loss, if for the hedging instrument we are talking about, if the gain or the loss on the hedging instrument, okay, is greater than loss or gain on the hedged item, it does not matter gain or loss, whatever the amount is, it should be higher than the gain or loss of the hedged item. Then the excess will go to profit and loss, the excess gain or loss. That means, let's say the hedging instrument gain is 500. Okay, 500, and 200 is the loss of hedged item. So only up to the amount of 200 will be recognized in OCI. The balance 300, because 500 is the gain of hedging instrument, right? So the balance 500 will be recorded in profit and loss account. You understanding? The balance 300, sorry. Only that excess gain or loss will go to profit and loss. The difference between hedged item and the hedging instrument. The one which is not excess will go to OCI, normal way. So remember, for cash flow, it's mostly other comprehensive income, and only excess goes to profit and loss account. For fair value, it's the opposite, mostly in the profit and loss account. Only if it's an equity investment at OCI, then only OCI. Otherwise, fair value, for fair value hedge. Now, discontinue hedge accounting. You cannot forever use hedge accounting. There are some condition that if it's not anymore there, you cannot continue hedge accounting. So you discontinue. So these are the following conditions. For example, hedging instrument, that means derivative, let's say it got expired. Let's say your option, it got expired, or option is exercised, or you have sold the option, or it's terminated. Hedge accounting also you cannot use, discontinue. Or the hedge no longer meets the hedging criteria, then also you cannot use hedge accounting. Or the focused, okay, the focused future transaction that qualified as a hedged item. Remember, when you want to hedge anything, it is something that has to be focused in the future. That's why you are using an hedged item. That's why you are hedging it, because in the future you don't know, you're not sure, uncertainty is there, you want to hedge it. Fair value will change in the future. So if that focused is no longer highly probable, that means there is very small chance of that happening, that transaction happening, then you cannot hedge it. It does not qualify as a hedged item, so you discontinue hedge accounting. And this discontinuance, one is decided that you are going to discontinue. How do you account for it? Prospectively. Prospectively means in the future, you don't go back and change it. Whatever happened up to the date, you don't go and reverse it. Keep it like that. From today, from that day onwards, stop using hedge accounting. That's it. So in the exam kit questions, these are the questions you can do. Crypto, Aaron, and art, right? And I have done all these questions. So you can go and check this out. And remember, financial instrument question does not come in very huge marks. Maybe if it comes also, maybe around 5 to 7 marks. Because I have got a question on a hedge. It was an embedded derivative, whether we have to separate or not. I got it for 5 marks. So even though this chapter is very, very long, but the portion of mark is very less on this area. Okay, so you can be at a relief, but still I would suggest that better to go through all these areas. So that's it for IFRS 9. Finally, we have completed successfully IFRS 9. So the next topic will be IFRS 10, which is consolidated financial statements, a very small standard and very important for group accounting. So till then, thanks for watching and see you in the next video.